Hey everybody, welcome to the channel. If you're new here, this is just a channel that's focused on following my journey on Wealthsimple Trade, trying to build a $500 TFSA to a $10,000 TFSA in using a dividend portfolio. So if you want to follow along with the journey, just hit the subscribe button, leave a like on the video so other people can find the video, and leave a comment. Let me know how your investing is going on, or if you have any questions, and also if you have any plans for the holidays. And tracking the portfolio performance so far on the day, we're up, but it's still early. The markets have been pretty volatile throughout the last week and even the beginning of this week, but they seem to be going up last couple days. Over the past week, we're down slightly, so not much change in the portfolio. In the last month, we're up $57, so about 1%. Last 3 months, we're up 4%, 349.87. And over the last year, we're up 903.29, about 10% or so. So let's just get into the portfolio and what's going on. So Apple, again, doing very well. No surprise there. We have Alimentation Couche-Tard actually just made an acquisition recently. So they bought a chain of convenience stores in New Mexico for which will give them about 19 income-producing grocery stores. So they definitely sit and wait for good opportunities to expand their business, and investors are clearly very happy because they have not made any moves to acquire new stores in a while. So this is pretty good. And Alibaba is still going down. No surprise there. A lot of negative news on, China, and as well as the business side itself, just because the growth rate isn't going to be 29% per year. It's going to be about 20 to 23, but I still think it's a good enough growth rate because growing your company at that size should increase their revenues and their profits by a lot in the future. The Canadian banks are pretty much all at all-time highs, so they're doing incredibly well. And a new position I started was buying Canadian Apartment Real Estate Investment Trust. So this is investing in apartment buildings. They own buildings in Canada as well as Europe. So I'll go into why I bought this in a moment and just talk about REITs in general. Dividend 15 is just our income fund. They just pay every month. We got this up from 77 all the way up to 80 shares. ENS dropped a lot, so this is just Enbridge. This is just another way to own Enbridge, get a monthly dividend that's much higher than owning Enbridge outright. So I invest into Enbridge using this fund. So we went up from 50 to 53 shares. And then Power Corp of Canada, I went up from 12 shares all the way up to 14. So for those of you that are unaware, they own a large stake of Wealthsimple, and they also own Great-West Lifeco. They own a lot of asset management businesses. They own Lion Electric. So very diversified business that can identify good, trending businesses that can have bright futures going into the long term. So very, very like this company a lot. And with Wealthsimple, they have announced like Wealthsimple Plus, so you're going to be able to purchase American stocks with no fees. I think it's just about $10 a month. So if they switch Wealthsimple to this kind of subscription-based service, that's the best revenue that you can have. I think that's one of the reasons why Apple's going up a lot, because their services segment is growing every single year, and that's pretty much like receiving a rental income. You're receiving regular income from your customers. It's predictable, and it's a very high profit margin, especially on services, because you don't manufacture a product at all. There's no shipping a product. It's more efficient. It's better. You make a program and then you sell it, and you sell it again, and you sell it again. And we also purchased a tiny bit more of Tesla. So this dipped down. I think Elon Musk is actually finally done selling his shares. And since then, it's rallied back from like the low 900s back up to 1,000. And I buy all these stocks and ETFs on Wealthsimple Trade. They offer no commissions on Canadian listed stocks and ETFs, and they also offer fractional trades on over 200 different stocks. So join my link in the description below to get yourself the value of a free stock. So what is a REIT? So a REIT is a real estate investment trust. So it's a way for a common person, a person that, can't afford real estate on their own, to buy a publicly traded company that owns a diversified portfolio of lots of real estate. So essentially, you can buy a company that manages real estate, whether it be buildings, industrial warehousing, commercial real estate, like, stores, malls, stuff like that. You can own a piece of that business, and the advantage would be you only have to pay for the price of a share of these enterprises, and you receive a monthly dividend from them because, as we know, at the first of the month or whenever, everyone has to pay their rent. It's very predictable cash flow, and you just keep getting charged no matter what happens. Like, you always pay your rent because you need a place to live, you need a place to have your business. Whereas owning physical real estate, you need a lot of money to put down. You have to, if you're renting it out, you actually need to find a tenant, and then you need to basically attend to any problems that unit has. So it's more hands-on than you'd think if you own your own investment property. But if you own it on the stock market, there's no work on your part. You essentially hire a company, they own all the buildings, they manage all the tenants, they do all the repairs, they deal with all the headaches. All you do is sit back, you get a monthly income from the company, and that's why I love REITs. So I'll just be going into comparing why I picked Canadian apartment REITs over other competitors. So over here, I'm going to go to wallmine.com, and you can put in a ticker symbol. So we'll put InterRent in there. That's one of the competitors I considered investing in. I chose not to just because of the valuation. So I think this is priced a little too high relative to the Canadian apartment REITs, but you can click on compare, and then I'm going to put in other competitors just to show my thought process here. And you basically can just put in the ticker symbol, and it will allow you to compare all the businesses together. So I go to valuation, and I look at price to free cash flow. That's going to be the most important field for me personally, because that is essentially the price of the share relative to how much free cash flow the business makes. So how much net income they make, basically, after all their bills are paid, how much cash is left, and how much am I paying for each dollar of cash flow. So for Canadian apartment REIT, I'm actually paying $15.47 for each dollar that they make. For Killam apartment REIT, which has a lot of renewables built into their units, and they have a concentration in other parts of Canada, not so much in Ontario, you're paying $37, which is a lot. That's more than 2 times what Canadian apartment REIT gets. We can look at the revenue growth. It's very, very similar. It's about 11%. And then we go down to InterRent. It's 27. So InterRent is trading at about a 40% premium over Canadian apartment REIT. And the revenue growth is a little bit higher than Canadian apartment REIT, but it's not 40% higher. So ultimately, I don't think it's worth the premium. One place where I think InterRent is superior, though, is their dividend growth. If you look on the bottom here, 8% dividend growth over the past 3 years, 7% on average, whereas Canadian apartment REIT has a lower dividend growth rate, but the dividend yield the starting yields are much higher for Canadian apartment REIT and Killam apartment REIT over InterRent. And so just digging deep into it, I like the valuation of Canadian apartment REIT, and I don't like it on InterRent. I love the dividend growth of InterRent. If the valuation improves for InterRent, somehow it became cheaper, I'd probably shift over to this. But for now, that's why I picked Canadian apartment REIT, because every investment you make is about buying a stream of cash flow. So the less I pay for that cash flow, the better my return will be. So that's why I picked Canadian apartment REIT over the others. And they're also diversified. They're not only in Canada. They have apartments in Canada, and they also have apartment buildings in Europe as well. So I like that diversification. And it just gives me access to another sector of real estate because people need places to live, and apartment buildings are here to stay. Like, people need places to live. That's not going to change. Maybe stores will close down, maybe the world will change slightly, but until people don't need places to live, I think apartment buildings are probably a safe place to be. And just going through CAP.REIT's investor relations and their reports, so we can see like their operating revenues are up, their net operating income is up, the funds from operation, the payout ratio, and we can see their figures compared to 2020. The increases all around. Payout ratio decreases. So the lower the payout ratio, that means the better the company can afford their dividends. So that's great that they decrease this number. That means that they can better afford the dividend. It leaves more room for raises in the future overall. And they're raising the funds from operation per unit. So essentially each dollar that they make is being factored into your shares. So when this happens, it typically pushes the stock price up because the shares are more valuable individually, and they have very high occupancy, like 98%. So doing fantastic there. They're strengthening, the tenants that they pick, and they're reducing debt as well overall. And when people move out of the buildings, they also tend to increase rents. So this is just like a steady trend over time. As people move, they charge the next person more rent. And they are definitely growing their portfolio. So in 2020, you can see they acquired, a lot of suites for $820 million. In 2021, they, bought more suites, and that cost another $803 million. And they sold like 87 suites for $52 million. So a disposition is the opposite of an acquisition when it comes to a business. That means you sell something, you don't acquire something. And yeah, you can see that the debt just goes down over time. So they're very good at managing their debt, not becoming, putting themselves at risk, especially if things turn in the market. And just about the diversification aspect of it, you can see that 44% of the portfolio is in Ontario. They still have, a bit of exposure, throughout Canada, like BC, Alberta, Saskatchewan, New Brunswick, Quebec, PEI, and Nova Scotia. But they also have 10% of their portfolio in the Netherlands. So that is another great reason to own this REIT, is that, you have a lot of exposure to Canada, but they're also expanding into the European markets. So, if something happens in Canadian market where they can start growing, or it happens in Europe, they can take advantage of that and put their money in the best place. So if you're concentrated in one country, you may be missing out on other opportunities. So that's pretty much it for today. So have a great day, everybody, and happy holidays. So we made it through this year, and it's a time to just appreciate what you have, enjoy time with your family if you can, if you're fortunate enough to do that, and just have a good outlook going into next year. Reward yourself this Christmas. You can definitely enjoy yourself this holiday season, and then in the new year you can think about your finances and how you can improve them for next year. Maybe you haven't started investing yet. It's probably a great time to do so, just because a lot of people have been affected by losing their jobs or switching careers, and just realizing that you can't rely on one stream of income. You need to have multiple streams of income in your life to protect yourself. It's way too risky to have all your money or all your income stream dependent on one source, and that's why I love dividend stocks. It's just a great way to get more income, and anyone can do it. All you have to do is just open an account, deposit money, buy the stock, and all the work is done for you.